Welcome to Market Brief After Hours. It was quite the roller coaster on the trading floor today. We saw a highly volatile session dominated by escalating tensions surrounding the Strait of Hormuz, keeping everyone on edge. But right at the end, markets staged a late session recovery. What exactly drove that last-minute shift in sentiment?
It was entirely headline-driven. Early in the day, equities were getting hammered by fears of an imminent escalation involving the US and Iran. The uncertainty was intense. But as we got closer to the closing bell, reports started circulating about a proposed delay in military action and renewed diplomatic efforts. That glimmer of hope was enough to bring buyers back to the table. Oil pulled back from its intraday highs, and that stabilization in risk assets really helped limit the broader downside. Still, it's a very fragile balance right now as participants await absolute clarity on the next geopolitical move.
Let's look at the major U.S. indices. The numbers really tell the story of that late-day tug-of-war. We need to look at where the chips finally fell, starting with the Dow.
The Dow Jones Industrial Average couldn't quite pull off a green close. It fell 85 points, or 0.18%, to close at 46,584. It did recover from much deeper intraday losses, but that late rebound just failed to hold the line. Volatility remained elevated throughout the entire session. On the flip side, the S&P 500 managed to eke out a very modest advance, gaining 0.08% to finish at 6,617. Buyers really stepped in during that final hour to rescue the index from earlier weakness.
And the Nasdaq managed to extend its gains despite the macro anxiety.
Exactly. The Nasdaq Composite rose 0.10% to settle at 22,018. That was largely supported by strength in technology shares, particularly anything tied to artificial intelligence. We saw some significant individual stock movements there, which definitely kept the tech-heavy index afloat, while the rest of the market struggled to find its footing.
Across the Atlantic, the picture was a bit bleaker. European markets seemed to take a broad hit as traders returned from the 4-day Easter break.
They came back to a completely different, much more tense geopolitical landscape, and it showed immediately. The Pan-European STOXX 600 index reversed its initial morning gains to finish nearly 1% lower. Looking at specific national benchmarks, the UK's FTSE 100 and France's CAC 40 both declined by 0.84%. Germany's DAX took a steeper hit, falling 1.06%, and the Swiss SMI dropped 1.48% by the close.
Was it purely the war deadline weighing on sentiment, or was there economic data dragging things down in Europe too?
The economic data definitely added fuel to the fire. We received revised PMI numbers that dampened the mood even further. The Eurozone composite PMI was adjusted down to 50.7, which marks its slowest growth rate since June 2024. In Germany, the services sector lost momentum, coming in at a PMI of 50.9. The UK wasn't spared either. Their services PMI fell to an 11-month low of 50.5. Plus, British firms are reporting the sharpest rise in input costs since 2021, mostly driven by massive spikes in energy and transport. The only real bright spot in the UK was car registrations, which saw a rare 6.6% year-on-year increase in March.
Speaking of costs, the inflation expectations data here in the U.S. had some eye-opening numbers today, especially regarding commodities.
Absolutely. The New York Fed's March survey of consumer expectations showed the one-year inflation outlook rising to 3.4%, which is a 0.4 percentage point increase, while the three-year outlook edged up slightly to 3.1% and the five-year held steady at 3%. Consumers are bracing for a massive shock at the pump and the grocery store. The one-year outlook for gas prices jumped a massive 5.3 percentage points to 9.4%, the highest level we've seen since March 2022. Food price expectations also rose to 6%.
And that ties into the manufacturing data we received as well, showing a bit of a slowdown.
It does. U.S. durable goods orders fell 1.5% to $315.5 billion in February. That marks a third consecutive monthly decline. It was driven largely by a steep 28.6% drop in non-defense aircraft orders, which really highlights the continued volatility and potential weakness within the broader manufacturing sector.
We are going to take a quick break. When we come back, we'll dive into the foreign exchange markets, look at some crucial moving averages, and break down the biggest individual stock movers of the day. Stay with us. Welcome back to Market Brief After Hours. Let's pivot to the Forex markets. There was some really interesting price action today, especially regarding key technical levels. Let's start with the euro against the dollar.
Euro USD actually edged higher today, closing at 1.1597, up 0.48%. The pair traded between a high of 1.1602 and a low of 1.1524. It was a firm bullish close, but the pair is still trapped underneath a very tight cluster of major moving averages. You have the 50-day simple moving average at 1.1688, the 100-day at 1.1685, and the 200-day at 1.1674. All three are acting as a heavy ceiling of overhead resistance. The momentum is showing early signs of recovery, testing the upper boundary of a short-term consolidation range, but immediate resistance is at 1.1602, followed by that moving average cluster. Support stands at 1.1524.
Did the British pound follow a similar technical trajectory?
Somewhat similar, GBP USD rebounded from support, closing at 1.3290, up 0.40%. It posted a strong bullish candle, but the broader downtrend structure remains completely intact. Just like the euro, the pound is trading below its key moving averages. The 50-day SMA is up at 1.3456, the 100-day is at 1.3417, and the 200-day is at 1.3419. Because all of these are aligned above the current price and trending lower, it reinforces a bearish medium-term structure, characterized by consistent lower highs and lower lows since February. Immediate resistance is right around 1.3300.
And finally, the US dollar against the Canadian dollar. There was some Canadian economic data that factored into the price action today.
USD CAD paused just below its recent highs, closing down slightly by 0.11% at 1.3895. It printed a modest bearish candle with an upper wick, suggesting some profit-taking after a strong rally, but the uptrend remains incredibly firm. The pair is holding above all major moving averages, the 50-day at 1.3699, the 100-day at 1.3776, and the 200-day at 1.3811. They are all trending higher, confirming a solid bullish structure. This pause in momentum happened right as Canada's IVPMI fell sharply to 49.7 in March, missing forecasts of 55.9 and signaling an economic contraction. Plus, their prices index jumped to 75.7, pointing to rising inflation pressure alongside weaker business activity. Before we leave the technicals, we should touch on gold. It's often a safe haven during geopolitical stress, and it certainly saw some movement. Gold had a strong day, rebounding from support to close at $4,698, up 1.08%. Buyers really stepped back in when the metal hit the 100-day SMA support at $4,645. This reinforces the broader uptrend, as the price is holding above both that 100-day mark and the 200-day SMA, which sits way down at $4,133. The near-term upside is currently capped by the 50-day SMA at $4,938, which is acting as key resistance. But overall, momentum is turning positive in the short term after a corrective phase from the February highs.
Let's wrap up with the big individual market movers today. There were some massive corporate headlines driving individual stocks, starting with a colossal takeover offer in the music industry.
That was the biggest splash of the day. U.S. shares of Universal Music Group surged 13%. This came after hedge fund investor Bill Ackman's Pershing Square Capital Management offered to acquire the company. It's a massive cash and stock deal, valued at 55.8 billion euros, which translates to roughly 64.4 billion US dollars. That kind of premium naturally sent the stock flying.
There was also some major movement in the entertainment sector with Paramount Skydance.
Paramount Skydance rallied 10%, actually leading the S&P 500 gainers today. They secured equity syndication agreements with Abu Dhabi's sovereign wealth fund vehicle, Limad Holding. This financing is a huge step to support their planned acquisition of Warner Bros. Discovery, and the market clearly loved the confirmation of that financial backing.
Earlier, it was mentioned that AI kept the Nasdaq in the green. Broadcom seemed to be the poster child for that today.
Broadcom climbed over 6% and led the gains in the Nasdaq 100. They announced an expanded long-term agreement with Google to develop tensor processing units, and they also confirmed plans to support operations for the AI startup Anthropic. Anything tied to expanding AI infrastructure is getting a massive premium right now, and Broadcom is positioning itself perfectly.
On the downside, Apple took a bit of a hit. What's the story there?
Apple fell more than 2% today. Reports surfaced indicating setbacks in the engineering test phase of their highly anticipated foldable iPhone. The The market is very sensitive to product roadmaps, and these engineering hurdles are potentially delaying production and shipment timelines, which made investors a bit nervous.
And we saw some executive shakeups causing a slide for Trade Desk.
Trade Desk dropped over 6%. Reports came out that 3 key executives are leaving the company. Whenever you see a sudden exodus of top-tier talent like that, it immediately raises concerns over leadership stability, and the stock price reflected that uncertainty today. Finally, ARM Holdings also weakened, falling more than 3% after Morgan Stanley downgraded the stock to equal weight from overweight.
Looking at the big picture, the session really highlighted how sensitive the markets are to the geopolitical landscape right now. Price action is being dictated almost entirely by headlines rather than underlying fundamentals.
Exactly. Equities managed to stabilize and avoid deeper losses today, but the lack of conviction in either direction shows a market desperately searching for clarity. With oil holding near elevated levels, West Texas Intermediate up to 112.95 and Brent near 109.62, and Treasury yields drifting lower, it paints a picture of cautious defensive positioning. The 10-year yield declined 3 basis points to 4.305%, and the 2-year fell to 3.806%. Going forward, traders are going to remain highly reactive. Until we see whether these Middle East tensions ease in a meaningful way or continue to create intermittent shocks, defensive strategies will likely dominate.
It will certainly be a critical few days ahead to see how these diplomatic efforts pan out. If you find this useful, please follow Market Brief After Hours.